Well, people, it's been a nice little rally there that we've been seeing in the financial markets, but is it time to snap back to reality? Some signals suggest that may happen. So we're going to talk about some various indicators in today's episode. We're going to talk about the S&P 500 and key levels. We're going to get into intermarket, different assets there. We're going to talk about what's on deck to watch out for in these markets. We're going to even give you a snapshot into some very key things as to why we've been seeing some really good setups overall in the market. Now, before we hop in today's stock market brief show, be on the lookout for some changes. My brand is getting a little bit of a facelift here in the next week or so. With all that said, let's get into it. Oakley dokley, everybody. Welcome back to the show. We're going to start off here with a snapshot. Just so you know, we have timestamps in the description if you want to skip around, but just be aware that you may miss some key insights. We're going to first look at the 11 sectors that make up the S&P 500. Now, I want to just call out something interesting. We had, obviously, a good run today in the markets. Notice how, some of the best performing products here was small caps. So small caps got a bid. They were the ones that have been selling off the most this year, that were down recently on the year. Now, if I look at these 11 sectors, what is the top performing sector? Utilities, a very rate sensitive sector, and it's typically more of a risk off sector. Now, towards the bottom of the list, you have tech. They finished flat for the day. But very interestingly enough, as we had a nice day in the markets, and we've been seeing a nice day in the markets, it was interesting to see that Microsoft, a big mega cap stock, was down on the day. Apple was down on the day. And Google, another big market cap name, was down on the day. Now, we've been in a decent environment. We've been very, very patient in this environment. And the reason why we've had to be patient is because we've been in this area of a declining 5-day moving average, which we've been talking about on all these episodes. So if you're new here and this doesn't make sense, well, you got to follow along, watch, and continue to watch, even though it might not make sense to begin. But we finally broke out of these levels, and the last time we discussed this was up here on the last video, and we said look for a potential pullback to the volume node, and we came back into that area and we started ripping. Now, where did we get hung up at? Well, we got hung up out right there at that within 2 cents of the upper weekly expected move, as this could very well be flagging or wedging, and we're pretty disconnected from now the inclining 5-day moving average. So when we got above here, things started to work out more in our favor from a swing trading perspective. Now, with that said, I want to remind everyone that yes, we are above a rising 5-day moving average, which is positive. However, when it comes to swing trading, it is nice to see us to be in a positive gamma environment. What that basically tells us is that when the market moves up, you have dealers or market makers selling into it, right? And then when it pulls down, you'll have buying go into it. So you'll have, it's a good time to buy the dip. However, we're in a negative gamma environment, which means that they will buy as prices moving higher in the S&P 500, but they will sell as prices declining. And what that does is that gives us more volatile swings, which we have been seeing. As you can see, a big move there and a big move down there. Now, the gamma flip level currently is at 45.27. That's looking at the range of expiration. So it's far, far away. So we're likely to continue to see massive swings in volatility. The next expiration is at 44.07, so not far off. And you can see that we tagged that upper weekly expected move there in the S&P 500. Now, if you want to see these gamma levels, these are important to know because this is how dealers have to position or reposition when they approach them or start breaking from these levels. I'm using spot gamma exposure levels. So the red, when prices below it, this could act as a potential area of resistance. And if it's green and prices obviously above it, this can act as a potential level of support, which is down here at about 4,200. Okay, so if you want these levels and more precise the numbers, if you can't see them on your screen, I have my chart deck in the pinned comment. And then also if you're watching on Twitter, I'll have it there too as well. We talked about the Q's diamond pattern. We had that measured move actually reach up to there and started rejecting from that level. And we're above that rising 5-day moving average. It's been a strong move. All right, IWM, it pulled back to that prior area of resistance. Once resistance is broken, it can become support, and it pulled back over into it. Now, there is a lot to talk about on deck. right? So we have a lot of important information from a macro perspective taking place. Tomorrow, an hour before the market opens up, we have PPI month over month, and the FOMC minutes is going to drop too as well. However, on Thursday, an hour before the market opens up, we have core inflation data, and then on Friday, we have Michigan consumer sentiment. So we have an array of different data points coming out. However, what's not shown here from a macro perspective, right? This is just macro data. There's also a lot of earnings taking place, and those of the likely of financials, so big banks, right? We have BlackRock, Wells Fargo, Citigroup, JPM. Okay, Pepsi reported today. 2 days we got WBA, which is Walgreens. And I wanted to just call out here that if I look at Walgreens from this perspective, it does look like a little inverse head and shoulder pattern. So this could be a bottoming pattern, but remember, earnings can be, a very binary type event. We don't know what's going to happen, but as it stands right now, looking at the next expiration into earnings, you can see implied vols obviously, swelled up like a puffer fish. It's at 1.62 expected move. So we can see this thing, come up from where it closed at, right? Boom, 22.38. We'll just tack on $2, right? 22 to 24. So it can come around to the upper 50-day moving average, or it can even come, back down to these levels at around 21, okay? That's some very quick math. But that is the expected range that we potentially will tag in the next coming days. But it is actually a decent looking potential setup. It just, unfortunately, with the earnings, it could be kind of a hit or miss aspect. So that's to note. The reason why I'm showing you these expected moves on earnings, because we have obviously big banks reporting, and we're going to be doing the same things probably leading up to, in just a few days when we get closer to those earnings being reported. Let's look at some intermarket stuff taking place. First and foremost, the 10-year yield. The reason why we want to talk about and be aware of these type of macro reports, especially inflation and PPI, is because they really do move bond markets, and bond markets can obviously, from an intermarket standpoint, really shift overall financial markets too. And today we had, a pretty large decline. And interestingly enough, these large declines can typically help growth stocks, but remember, those correlations don't always have to hold up. So we had this drop, and we saw obviously markets up today, but like I said, the big growth names, some of them just did not actually perform, like Microsoft, Apple, and Google previously mentioned. Okay, so the 10-year yield is going to continue to watch. We had that shooting star candle this day over here. The the bond market was closed. Okay, and then we pulled back a little bit today. I wanted to just call out this yield curve, the 10 and 2, as it's been kind of flattening itself out right here at minus 30 basis points. Okay, and then the S&P 500 has been rising a little bit. Now, as we've noticed, as the yield curve starts to uninvert, it does put pressure on the markets. We had this pretty big uninversion right here on the prior week. It moved down, and we're starting to see a reflexive bounce, but this hasn't really came down at all. So is that telling us that saying, hey, are we going to be snapping back to reality? Potentially, all right? We don't know for sure, so we'll map out some key levels momentarily. As the 10-year yield dropped today, we saw we've been seeing, I should say, the TLT pop up slightly. Now, what I find interesting here is the 10-year yield dropped pretty significantly today, but that didn't really do much to the TLT we're using as the proxy for the bonds. This was down slightly. However, it started a lot lower and closed rather unchanged. Another interesting aspect is looking at copper. Copper was down on the day while the S&P 500 was up, and I like to look at copper because you can spot divergences where copper is falling, S&P 500 is going up, but then yet it gives us insight saying that, hey, Dr. Copper is signaling something that the market's not quite catching on to, and it could be a potential leading indicator, which we've seen the bottoming right here where S&P 500 made a new low, copper made a higher low, and that gave us insight actually into this big rip right here. On the flip side of that, right, we've seen copper put in lower highs while the S&P 500 put in higher highs, and that gives us insight to potential times where the market can fall. Oil, there are geopolitical risks at stake. We saw this big pop up, so a lot of defensive type names, including, which we're starting to see now, utilities start to rally. So we've seen a lot of defense, which is not typically great for the markets, but we did have an inside trading candle today as we're trading back above that 50 period moving average. Another important aspect to watch is the dollar. So the dollar has been taking a little bit of a breather here. Are we starting to break this trend to give us a period of more consolidation, or is it going to pull off more? But you can just see here from a correlation perspective, as the dollar's been falling, look at the S&P 500. So most of this move, in my opinion, has been a feature of a falling dollar helping out these markets. Okay, let's take a look at the S&P 500 really quickly, weekly time frame. We said as it was down here in the red, we're very extended from the 5 weekly EMA, and when we're extended, we can get snapbacks. That's both from an upside and a downside perspective. We were down here, we snapped right back into it. Remember, it's still declining to slightly up right here as price action slightly above it, but we still have clearly a lot of time left in this week. Now, from the daily perspective on SPY, we're still holding that year-to-date anchored VWAP, and the quarter-to-date, we are above it and it is inclining. So right now, from a daily perspective, I'm saying that this right here is bullish, but does bullish mean that the time to enter is right here? No, that's not what it means. But what happens if price comes in here and comes, we see a big drop, in the next couple of days, say back to the quarter to date, and it's inclining. Okay, well, see how price action responds at that level and see if we start to see strength and then offers up what's known as a higher low. That would be positive, right? This over here is known as a shooting star candle. And like I said, we're in a negative gamma environment. So as price action is moving up, buyers buy. But remember, if we start breaking down, we can start seeing a fast sell-off, okay? So if I take a look here, what's going on? If I take a look here at this specific candle, if we start breaking the low, yeah, that opens the door to obviously head a little bit lower, but I want to really zoom in here on the 15-minute time frame and look at a couple other levels. So the green, right? The green level is the quarter-to-day anchored VWAP. The purple line, that's the 5-day moving average. You can see it was resistance. We finally broke above it. That's when swings trading strategies start to work really well. We are above the week to date that held as support, and we're still holding above it. So what I like to do here, as we tagged into the upper weekly expected move, and this is the high so far for the week, is I'll apply an anchor VWAP up to the high of the week, and you can see when we broke down, it held as a resistance. The resistance level is right at around 435.70, which is prior resistance. Okay, so I'm thinking that if we can start breaking above this level and start reclaiming the swing high of the week of the anchored VWAP, that might open the door back up to the daily expected move for tomorrow, which is 437.78. Remember, these expected moves, they're not just levels I put in there and say, I expect this. These are levels that are based off of implied volatility coming from the options market, okay? Lots of money traded in the options market. Same with the weekly expected moves, okay? So if we start getting above these levels, I think that opens the door to retest the upper weekly expected move. But be in mind, if we start continuing to fall, pay attention to the week-to-date anchored VWAP as it's inclining, so it could potentially hold as a level of support. You'd want to see price action obviously hold that, maybe undercut it, right? Tag the daily expected move, but you want to see strength coming from that and getting back above the anchored VWAP for the week. If it starts trading below it, right, it could potentially start changing course, start trending down, and so forth, where we can see continued sell side activity after a run up. But as you can see, we ran up, right? We contracted, boom, we broke out. Right now, we're just pulling back after tagging what was already expected for the week. Okay, so those are some key levels to watch out for the remainder of this trading week. If we take a look at some of the indicators, what are they telling us? Look at the NDX had the bullish percent index. We had a positive divergence in the RSI. It's resolving itself to the upside, okay? We had a positive divergence on the Nyse-McClellan oscillator. Okay, we talked about it. It's resolving itself to the upside, right? We call out negative divergences, positive divergences. It tells us when the internals are speaking a different story than the price action alone. It's always good to have some sort of an edge and just keep an eye out when this is taking place. Now, if I look at the summation index, this one's actually fish hooking right now, which would be positive, but it's still below zero. And it's obviously below the parabolic SAR. We like to see this cross back above the parabolic SAR to uptick, and that can identify a potential change in trend as it did right here. That was the last, and we kind of moved up, but then it ticked back over, and we identified a new change in trend. Same thing right here. It identified a change in trend. Boom, we started moving up. Change in trend, as you can see, boom, started moving down. So it's a very helpful indicator to see potential shifts in the market. Same with the NASDAQ summation index. You can see here we had that positive divergence actually in the Nyse-McClellan oscillator. Summation index, though, for the NASDAQ is starting to fish hook, and it looks like it's a possibility that we come back up, get a positive crossover, and that might open the door to further upside, right, in the NASDAQ composite, which is full of semiconductor stocks. That's a big weighting, tech stocks, all kinds of stuff in there. It's a huge broad market index. The last one I want to close off with was on the thumbnail. This is known as the old fool indicator. The old fool indicator is taking the Nasdaq composite and dividing it into the put to call ratio, the total put to call ratio, and you see that purple line in the background. It's all choppy. So we smooth that out with the 21 and 50 EMA, and you look for crossover. So we had a bullish crossover around here, and that's when the market started trending up, and it gave us some good insight that we could see a nice move. We did have a bearish crossover right over here, and it's a lagging indicator, but it gives us insight into potential changes in trend for the longer term. And you can see it was right around this area, and we moved down. We had a snapback, right? But we snapped back to reality. Boom, right back to the downside. And it's trending still down. We're starting to snap back up, all right? And this could very well just be, what's known as a lower high, right? In order to be more confident, you'd want price to start breaking this high over here when looking at the Nasdaq composite. Because even if price were to come up further, right, we'd have a high, a lower high, a lower high, and this right here, even if we come up more, would be considered a lower high, which is stair-stepping ourselves down, and that could open the door still to follow the trend of making lower highs and lower lows, okay? Now, what you'd want to see is this obviously to cross back over, boom, and then that can identify a potential change in trend as well. We talked about a lot on today's Stock Market Brief, people. Hope it helps out. That's all I got for you. If you guys want to check out the swing trading Patreon Discord community, feel free to click the link in the description. Like I said, and I've been saying in this entire time, when it comes to like going long and swing trading, it's better to be in an environment with a rising 5-day moving average and a positive gamma environment. But when we get that rising 5-day moving average, I mean, these names typically you see a lot more progress in your swing trade. So like Tesla was up, right? We saw a good move there. BRC is still consolidating. It was down slightly. ENVX was consolidating very tightly there, and we popped out, made a nice little profit there. Target was another one of the trade ideas coming out of an inside trading candle. And when these, we put more trade ideas out there, or I put more trade ideas out there when we're in that type of environment. But yeah, I have all kinds of stuff here. It's only $9 a month if you want to check it out. Even my watch list, I'll share my watch list, which I even added now what's called a tight list, which I give a PDF document of the names from the watch list that are coiling up. So for example, like GPCR is probably up, I believe. This one, it was up quite a bit. SCS, which I have a position in, I played that one today. That was up. HCC, not all of them go up, but what they all do and they all present themselves is, a tight period of consolidation, and then you play the expansionary move to the upside and or to the downside, but it gives you a opportunity to take a trade and have very, tight risk to potential reward, right? The markets move between expansion and contraction. I look for areas of contraction. I play the breakout, and I have a tight stop loss. I keep it pretty simple, not much more to it. That's all I got for you. Later.